Hello, this is Danny of Financial Planner. Today I'd like to talk about some of the different investment vehicles that you can use to implement your stock and bond portfolio. Usually the main two options that you have are mutual funds and exchange traded funds, or ETFs. So which of these might be better for you in your investment implementation? So thinking about the two of them there's similarities and differences. So to think about the pros and cons of both, I'd like to outline some of the attributes for each of those. So firstly, thinking about an exchange traded fund. Usually, exchange traded funds are more tax efficient than mutual funds. And the main driver of that is because of their entity structure or business structure, I guess. They don't have to, or they don't produce as many capital gains and therefore don't have to pass them on to their investors. So the main reason for that is because ETFs can exchange their portfolio securities in kind, meaning if they own 100 shares of Apple stock, they can exchange that rather than sell it. So that's just something that you don't really need to know, but it makes them a little bit more efficient from a tax perspective. So thinking about a mutual fund, if they have to sell 100 shares of Apple stock to generate the cash to refund investors their money when they sell, then if there's a gain in their portfolio on those shares of Apple, then they have a gain from the sale and they have to pass that on to their investors. And unfortunately, it's not the ones that sold the fund that get that allocation of gain. It's those that continue to hold the fund. So comparing the two there, ETFs are better because they don't have that sort of tax implication of redeeming for the investors. So another thing to consider is that ETFs are usually lower cost from an expense ratio standpoint. So if you compare two Vanguard funds, the ETF version versus the mutual fund version, the ETF version is usually a little bit cheaper. So maybe 1/100% or 0.03% cheaper, but every little bit adds up over time. So definitely something to consider there. So in thinking about trading ETFs versus mutual funds, that is a con for, I would say it's a con for the ETFs. So when you're buying a mutual fund, you say, I want to buy $10,000 of this fund, and you send the money over to the fund company through your broker, or you can send it directly to Vanguard, for example. Now, what happens there is that Vanguard says at the end of the day, well, I own 1,000 stocks in this portfolio. Let's value them at the end of the day and give this person the number of shares that correspond with their purchase price based on that fixed value at the end of the day. ETFs trade on the open market in a point of difference between mutual funds. So you can buy it at 1:03 p.m. or 1:04 p.m. in 30 seconds or whatever it is. So you're buying it from someone else in the open market, meaning the price that you pay may not correspond to the underlying basket that ETF holds. So it may differ by a little bit. Another issue at that time is when you're buying those shares of the ETF from the other person, you're agreeing to pay whatever price they want at that time. So say it's trading at $50 a share, but that was the last trade. The person that's selling it now wants $50.10 per share for the same security 10 seconds later. So you may think that that's great. I can buy it at this exact moment. Well, the problem there is you just paid 10 cents more than potentially what the value is. And the cost there is 0.2% difference, that 10 cents on that $50 a share purchase price. So if you're trying to save 0.03%, like I was saying earlier, but the transaction cost was 0.2% because of that change in the price, you just lost out big time, and it's going to take you 6 or 7 years to recoup that initial purchase price transaction cost. So that's something to consider from a trading perspective. So in the end, thinking about mutual funds versus ETFs, I think ETFs are a great vehicle to use if you're not trading it frequently and those transaction costs are very low. So one of the things to gauge that is look at the bid-ask spread on an ETF when you're purchasing it. So if they're within 1 penny or 2 pennies of each other, that means the person that's bidding or wants to buy the shares, wants to pay $50.09. But the person that's selling it, they're asking. So that ask price is $50.10. So if that's within a penny, then that's pretty negligible. If the spread is much wider, like 10 cents, like I was saying before, that's when it gets fairly expensive transaction cost wise. So something to consider when you're shopping for ETFs that way versus a mutual fund. So that would be my top tip there. But overall, if you're having minimal or low numbers of transactions, only buying once per year or whatever it is, an ETF's a great vehicle because you're saving on the expense ratios and the tax cost. So hope that's helpful. If you want to talk further about that, I'd be more than happy to. You can contact me through the website. Up there is a schedule a call link. Just go ahead and click that and find some time on my calendar. Once again, this is Danny from Financial Planner. Have a great day. Thank you.